Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Don't buy Rocket Lab, sell puts instead. Rating downgrade to hold. April 55 strike, sell puts now.
Don't buy Rocket Lab, sell puts instead. Rating downgrade. This article was written by Prop Notes. Summary. Rocket Lab Corporation has executed exceptionally, transforming into a high-growth, vertically integrated space company with a robust backlog and expanding margins. Despite strong fundamentals, RKLB now trades at an elevated 79x sales, making current share purchases unattractive given payback periods and profitability timelines. I recommend selling put options, specifically April $55 strikes, to capture yield or enter at a more reasonable 47x sales, balancing risk and reward. I'm downgrading RKLB to hold, as I see selling puts as the optimal strategy for new capital deployment at these valuation levels. Over the last few years, I've covered shares of Rocket Lab Corporation, RKLB, 5 times, rating the stock a strong buy or buy each time. Those who have followed my bullish ratings have done quite well, with shares appreciating more than 1,400% since my first article. Rocket Lab, as a company, has performed spectacularly over this span. The company's launch business has grown and become one of the most credible in the industry, and the firm's space systems segment has structurally transformed RKLB into a high-growth business with embedded operating leverage. As the model evolves, the launch segment promises to act as a strategic enabler for the company's space systems business, which could drive meaningful long-tail shareholder value. As it turns out, being a vertically integrated space company can be highly lucrative. However, since I first covered the stock, shares of RKLB have increased in price from roughly 10 times sales to over 80 times sales. Obviously, some part of this reflects a broader market understanding of Rocket Lab's true opportunity. That said, the price has now reached a point where I no longer believe buying shares is the best way to profit from the company. Selling put options on RKLB, which offer a better entry point if assigned, while paying out a robust cash-on-cash yield, appears to be a much better risk-reward play. In this article, I'll cover recent developments at Rocket Lab, highlight my concerns about the valuation, and make the case that selling put options on RKLB is a more optimal way to deploy capital than buying new shares outright. Sound good? Let's dive in. Financials. Let's start by taking a quick look at the company's financials. I haven't covered Rocket Lab since July of last year, so it makes sense to update readers on my view. In short, RKLB is still firing on all cylinders. In Q3, the company reported revenue of $155 million, up 48% year-over-year, marking a new quarterly record. Space Systems revenue of $114 million was up 16% sequentially, crowning the segment as the fastest-growing, largest, and highest-margin part of the business. Launch Services also reported revenue of $41 million, with 17 new Electron launch contracts signed in the quarter alone. So as the title says, it's been a record-breaking quarter for launch contracts. 17 dedicated launches were signed in just 3 months, but all but 2 of them were signed with international customers from Japan, Korea, and Europe. Those new missions, plus the ones already on the books for international space agencies like ESA and JAXA, prove Electron is not just a leading launch vehicle in the United States, but it's becoming the preferred small launch vehicle globally. The company's backlog of $1.1 billion also remains robust and is almost evenly split between space systems and launch contracts. We ended Q3 2025 with approximately $1.1 billion in total backlog, with launch backlog accounting for approximately 47% and space systems representing 53%. Taken together, the company's rapid pace of launches, strong space systems growth, and significant demand from both commercial and government customers highlight just how well Rocket Lab has been executing. The growth of space systems also shows that Rocket Lab is no longer just a preferred launch provider. It is also a trusted source for satellite manufacturing, components, and mission operations services. As Rocket Lab transforms into a vertically integrated space company that sells the ride to space in addition to hardware systems and services, I believe the company's model improves and has become inherently more valuable. We can see this reflected in the company's margin profile. In Q3, GAAP gross margins came in at 37%, which was at the top end of management's prior guidance. This relative outperformance was driven by mix and scale in the space systems segment. Not only that, but non-GAAP gross margins were reported in the low 40% range, indicating stronger underlying margins once you strip out Neutron ramp-up costs. Given that management sees Q3, Q4, and Q1 of 2026 as a period of peak spending on Neutron, I expect GAAP gross margins to continue expanding toward 50%. However, we expect to see a shift in spending from R&D to flight to inventory, which is an encouraging sign of progress as we move closer to Neutron's first flight. I'm optimistic that with the impressive strides we've made towards this milestone, we're approaching peak Neutron R&D spending and are on the path towards meaningful operating leverage and positive cash flow in the future. In combination with a successful Neutron launch and ongoing growth in space systems, there is considerable operating leverage for RKLB to unlock. Finally, it's worth pointing out that I believe the company has enough resources to get over the line on key projects. Free cash flow is negative today, largely due to significant capital expenditures, but with more than $800 million in cash and total liquidity exceeding $1 billion, including revolver capacity, I believe management has enough runway to reach positive free cash flow in the coming years. Analysts currently predict RKLB earnings per share to turn positive by the end of full year 2027. Personally, I would be surprised if RKLB is able to generate even a modest profit over the next 24 months. That said, if revenue continues to scale as the company executes on its current backlog, secures significant new business, and grows its lucrative space systems segment, at the very latest, I think GAAP profitability is possible in 2028, assuming no Neutron fumbles. The price. Historically, I have viewed Rocket Lab's price through the lens of its sales multiple. With no profits to speak of and significantly negative cash flow driven by ongoing Neutron R&D, price to sales has always been the most appropriate valuation touchpoint in my mind. Now, however, I believe the valuation has expanded to fully reflect, and then some, Rocket Lab's future opportunity. When I first covered the stock roughly 2 years ago, shares were trading at about 10 times trailing sales. To us, this seems modest. While the figure is about 10x TTM sales, with the improvements RKLB management expects to achieve in the coming quarters, on both the revenue front as well as the profit front, it seems a bit cheap. 6 months ago, Rocket Lab was trading at roughly 55 times sales. At present, RKLB is trading at a price-to-sales ratio of roughly 55x. Today, shares of RKLB are trading at approximately 79x trailing sales. This multiple expansion, combined with organic growth, is the primary driver behind the stock's historic run. Additionally, as the space systems segment becomes a more prominent part of RKLB's overall business and the company's vertical capabilities come into focus, there is an argument that some multiple expansion is warranted. However, 79x trailing sales for a business growing revenue at under 50% year-over-year implies a patently absurd payback period. Even if Rocket Lab achieves sustained revenue growth in the mid-20% to 30% range, shares would not trade under a 10 times trailing sales multiple until roughly 2033. Even assuming gross margins of 50% and net margins of 20%, which I think could be a reasonable steady-state outcome for RKLB over the long term, shares would still be trading at roughly 44x 2033 earnings. In my view, this is simply too expensive a stock to buy with fresh capital at today's price. The trade. Instead, I believe selling put options on RKLB is the most optimal way to play the stock. For those unfamiliar, selling put options is essentially a financial transaction similar to placing a limit order. The key difference is that you get paid upfront for bidding on shares, and you are only assigned shares if RKLB is trading below the strike price at expiration. I view selling puts as an attractive choice here because I would like to own RKLB, but just at a much better entry price. Getting paid to wait for that price makes a lot of sense. This is why I believe selling the April 17th $55 strike put options appears optimal. These options expire in 77 days and have a break-even roughly 40% below the current share price. When entering this trade, you immediately earn a cash-on-cash return of 4.36%, derived from the $230 premium received against the $5,270 in required margin. That yield annualizes to nearly 21%, which significantly outpaces what investors would otherwise earn from bonds, fixed income, private credit, or most other yield-oriented strategies. Expiration-wise, I prefer contracts in the 70 to 120-day range, as this has consistently proven to be a sweet spot for selling options. This timeframe offers attractive yields for far out-of-the-money strikes without tying up capital for years on end. Additionally, I view the $55 strike as a more attractive entry point. With a roughly approximately 39% downside buffer, investors would pay only about 61% of the current share price if assigned. This implies an entry valuation of roughly 47x sales, which, while still expensive, is far easier to justify. It also shortens the company's implied payback period, assuming execution broadly tracks current analyst expectations. Risks. As always, there are risks associated with selling put options on RKLB. First, the stock is extremely volatile, and earnings are expected to be reported before the above option expires. Day-to-day volatility or an earnings-driven move could push shares below the $55 strike, even if the long-term outlook remains intact. This isn't necessarily a negative, but it's worth knowing. Second, if RKLB encounters issues with Neutron over the next 77 days, such as a launch failure or material delays, then margins and R&D spending could remain elevated for longer than expected. This would negatively impact the company's payback profile, net present value, and ultimately its share price. Finally, being assigned RKLB shares at roughly 47 times sales, while meaningfully cheaper than today's valuation, is still expensive in absolute terms. Investors currently appear willing to grant RKLB a longer payback period due to the capital-intensive nature of the business. But if that tolerance shifts, 47 times sales would represent a frothy valuation for a company that remains unprofitable today. Summary. While risks remain, I believe selling put options on RKLB is the best way to deploy fresh capital into the company. Investors either earn an attractive cash-on-cash yield or acquire shares at a substantial discount to the current price. Given that my view on RKLB is driven primarily by valuation rather than business quality, selling puts represents a compelling middle ground. As a result, I am downgrading RKLB to a hold rating and would encourage investors considering a new position to explore selling put options instead of buying shares at these heights. This article was written by PropNote.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.